Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, September 10th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is consensus still wrong about tariffs? Our answer: yes, at least that's what the August PPI data signaled. While we always caution against overreacting to any one data point, this data point is consistent with our long-held beliefs regarding the outlook for U.S. inflation. Per our May 28th leadoff morning note, by late Q3, early Q4, we believe Wall Street consensus will have adopted our structurally bullish paradigm C thesis as their modal outcome. The fact that growth is slowing throughout is the primary culprit for their delayed recognition. Instead of positioning for the continuation of the fourth turning inspired fiscal and monetary largesse, plus substantial deregulation, plus reshoring of critical industries, each being a durable positive shock to growth, many investors remain myopically focused on the transitory negative shock to growth from tariffs. Let Wall Street consensus remain on the other side of our trades while they continue to get swindled by the mainstream media's overselling of fear that will no doubt ratchet higher in the coming months as still resilient hard data converges towards unresilient soft data. Undisciplined investors will overreact to the growth slowdown and use it to support their confirmation bias. Moreover, congressional brinksmanship regarding the One Big Beautiful Bill Act and incremental brinksmanship regarding trade negotiations are also likely to trigger volatility this summer. Faded. We continue to believe there is a high probability that the next 20% delta in the U.S. stock market will be higher, not lower. The next 10% delta may be lower, but who cares? Buy the dip until you hear us officially dismiss Paradigm C as the modal outcome. And for those keeping score at home, the S&P 500 is up 11% since May 28th. Hope you guys have been participating. An alternative view regarding the impact of tariffs upon the U.S. economy is that the Trump administration may be cooking the inflation books. If the administration is cooking the inflation books, and allegedly, don't get upset by it. And more importantly, don't ever let your emotions affect your portfolio. Remember, your most important goal in the current risk-on market regime is to maximize upside capture during our raging Paradigm C bull market. Don't worry about minimizing downside capture until KISS and Dr. Mo signal that Paradigm C is over or about to take a hazardous intermission. All told, our general take on tariffs remains unchanged from a month ago when the July PPI data spooked investors via pricing in a directionally hawkish Fed. Per our August 16th around the horn, investors should expect the following three things to occur over the next 12 to 18 months. Number one, reported inflation is heading higher, but generally not at a speed faster than the consensus already anticipates. Thursday's PPI beat notwithstanding. Number two, the timing of tariff-related price increases will be nonlinear and vary across sectors and companies based on profit margin cushions. And number three, at some point, the tariff impulse will wear off and inflation will start heading lower again. The FOMC will be foolish to overreact to these proactively predictable, transitory dynamics with an ill-timed defense of their arbitrary 2% inflation target. Transition to our 42 macro dashboard. As always, we'll wrap up with a question from our community. This one's titled Impact of Employment Revisions. It says, hi, Darius, loving the service and the incredible depth of research. I have learned a ton since joining last October and have never felt more confident in the positioning of my investments, Let me read that again. It says, hi, Darius, loving the service and the incredible depth of research. I have learned a ton since joining last October and have never felt more confident with the positioning of my investments. 42 macro in a nutshell. Getting back into the question. Adam Taggart posted a quote from Lacey Hunt. Wage and salary compensation, total personal income, private savings, gross domestic income, national savings, industrial production, and productivity will all be revised lower since the preliminary data of all these indicators use the monthly payroll jobs, which so massively overshot actual employment growth. Curious if or when prior economic metrics will get revised. How do you see this potentially impacting the estimates for market regime, VAMs, and where we are in the U.S. U-shaped economy? Phenomenal question, outstanding question. So, really, really grateful for the breadth and depth of knowledge we have here in our community in terms of the questions that are being asked and answered, not just by me, but by other very thoughtful investors. We have thousands of clients in 80 plus countries around the world. From our data, we can see that roughly half of our clients are retail, the other half are institutional investors. And so they're all in here asking and answering really thoughtful questions. So we're super appreciative of that because our community obviously is making itself smarter. So getting into answering the question. So curious if or when prior economic metrics get revised. So each of these metrics will get revised when they get reported. So that's one step. So you don't have to live in fear of like some big day like yesterday with the QECW report coming down and telling us we had a 911,000 jobs missing from the economy relative to what was reported at the time. I thought it was pretty funny. It's very ironic that the number was minus 911. Because obviously 911 is the number you call for help. Help, the labor market needs help. Cut the darn rate already, help. That's what I thought. Sorry, I cracked myself up. When you're sitting in a room by yourself, cranking on data and models all day, sometimes you need to make crack some nerdy jokes. So hopefully you guys enjoyed that. But anyway, so that's very it's rare that we have these like one-off big kind of big revision days, where everyone's sitting there waiting on the same revision. That's rare. We do get annual benchmark revisions to the PCE data. We get annual benchmark revisions to the CPI data. I want to say those occur in late January and or February. But generally speaking, the data themselves take the revised payroll data and flow it through to their next upcoming reports, of which they'll revise their data appropriately. So it's a pretty dynamic process. So it's not like you need to be living in fear of like one big day. So how do we see this potentially impacting the estimates for the market regime? I don't think the data revision, as we see in yesterday and today, the negative data revisions are making us increasingly right on our call for the Fed to, our call that the J-Powell Fed is already mired in its fifth major policy mistake and needs to respond to the labor market yelling, help, Jay, help, and then lower interest rates. And obviously the markets are, taking that in stride in terms of pricing in incremental monetary easing. By and large, estimates or revisions by and large. This is one of the weirdest years ever for a variety of reasons, both economically and geopolitically, but that's neither here nor there. But this is just revisions have had an unusually outsized impact on financial market risk on the day this year. But broadly speaking, revisions is not something you need to be overly concerned about as an investor. What you need to be concerned about is the evolution of the growth, inflation, monetary policy, fiscal policy, liquidity, and positioning cycles. That's it. And the evolution is about what those things are going to occur, what's going to occur in the future. And so I think what these revisions confirm is that, hey, Darius Dell's right on his U-shaped economy thesis. When we authored the Paradigm C view, the Paradigm C view contained within it, hey, we're actually in the U-shaped economy, but the whole point of Paradigm C is that the economy is going to U, not L or I, go straight down. It's not going to L, go down and stay down. It's going to go down, kiss the bottom, and start to reaccelerate again as a function of all the dynamics that we carefully laid out in the context of that Paradigm C thesis, a theme which we authored back in April. I think it's just more confirmation of the U-shaped economy. So, and the more confirmation we get of the U-shaped economy, the more likely it is that the Federal Reserve undoes the Powell Fed's fifth major policy mistake by supplying the monetary easing that's priced in that the labor market very clearly needs, because it's screaming help, according to the minus 911 revisions to the QECW report. And then scrolling down here, there's a secondary set of questions here that I thought were very thoughtful as well. So I figured let's unpack these as well. So this one reads, had similar lines of thoughts and add-ons. What are the odds a recession to be declared post-mortem on revised data for 2024 in the first half of 2025? What's the impact of going forward? I don't think that the odds of that are very high. We would have seen it in a variety of indicators. Obviously, we run our 42 macro business cycle model to give us a very, what I think is one of the industry's best, kind of forward-looking views on the probability of experiencing and or being in a recession over a medium-term time horizon. That never signaled we were likely to be in recession. When you look at initial and continuing jobless claims, particularly the 3-month annualized rate of change of the 4-week moving average of initial claims and the 3-month annualized rate of change of continuing claims, we breached the recession signaling threshold 5 times in the initial claims data over the past few years, 4 times in the continuing claims data over the past few years, and each time we've actually gone back down. And so that's consistent with our friend Mike Wilson over at Morgan Stanley. He's had this view for a few years now that, hey, the economy is experiencing these rolling recessions where they're, as opposed to one big broad base decline in consumption, production, income, and investment, which is what the NBR is looking for when they put the red bar, the gray bar on the charts that we're viewing. Instead of experiencing that, we're experiencing, hey, this sector has gone into recession and eventually come out. That sector followed by this sector, that industry, that company, this company. And ultimately, part of this kind of K-shaped economy thesis that we've been espousing is that the small businesses and the low to median income consumers have not recovered from their rolling recessions. They're just like, it's just been a languishing multiple years of crappy economic outcomes for them. For a variety of reasons. One of the reasons is that the Fed is not playing ball from a fiscal, monetary, financial oppression, and monetary debasement perspective, and allowing enough capital formation among those cohorts of the economy. And so we think that's coming. That's part of the paradigm seat thesis. It's not going to come anytime soon, or we're not going to get enough of it on a very short time horizon. But we know that over a long-term time horizon, we believe over a long-term time horizon that it is coming. And that's not something you want to stand in the way of as an investor in terms of trying to short the market prematurely or not maximizing upside capture in paradigm C. And so what's the impact of a recession being declared going forward? I mean, who cares if a recession was in 2024? The orange man is going to say on Truth Social, if that was the case about the Biden economy, or in the first half of 2025, we know it's Treasury Secretary Scott Bessent is going to say, well, we're just wringing out the crap from the Biden economy. So I don't think it's going to have much of a market impact. Aren't recessions usually short? I hate the word usually. The word usually implies like we should be expecting, some sort of kind of like a cookie cutter outcome. Every business cycle is different. Every market cycle is different. The way in which we view the world is through the prism of regime segmentation. And so we recognize that there is, dispersion within each regime, but there's general things that we should take away from each regime. Recessions being usually short or usually long, I don't think it's going to really make a difference here. If in fact the economy was in a recession in 2024 or the first half of 2025, I don't think that's going to have much of a market impact. And then finally, has the likelihood risen that the 2026 first half initially reported data will show upward momentum first down the revised 2024 and 2025 data? To me, that's the biggest impact of all this, and I'm glad they actually put this in the question. The worse the economy was looking backwards, the better it's going to be looking forward. When you think, and when you think about the growth rates, the year-over-year rates of change, the quarter-over-quarter rates of change. And so the worse the economy was in the first half of 2025, the better it'll likely look in the second half of 2025. The worse the economy was in 2024 and 2025, the better will likely look in 2026. And this goes back to something we've been talking about since we authored the Paradigm C theme back in April, which is consensus growth estimates are way too low. We saw in the biggest beat in quarterly sales and earnings in the second quarter since 2021, almost 4 years. If you look at our short run potential GDP growth expectation for the U.S. economy, that's the blend of the current year and the next year growth estimate among Wall Street economists' consensus. That gives us a proxy for what's the general level of growth that strategists and analysts are kind of putting into their models to strip away the impact of base effects. That number went down from 2.2%, a peak of 2.2% in February, to a trough of 1.5% in April, and has meandered higher to 1.7% here in September. 1.7% is too low in the context of Paradigm C. The economy could grow 3 to 4% next year. The economy could grow 3 to 4% next year on a real basis. If we're right on Paradigm C. And so, the consensus estimates are for growth are way too low. And this goes back to what we started the question today in today's macro minutes. Consensus still wrong about tariffs? In our opinion, yes. We've been pounding the table on that since early May in terms of, essentially calling out, saying, hey, consensus is taking its growth estimates down way too low, both on from a macro standpoint, GDP, and micro standpoint from earnings. And they've taken the inflation estimates up too high in terms of the expectations for CPI, core PCE, and all we've gotten since in terms of the data and the market performance, emphasis on market performance being the more important thing to figure out. But both the data and the market performance are telling consensus that it's wrong about tariffs. And quite frankly, it's, if we're going to be honest, it's kind of telling the mainstream media that it's overly myopically focused. Its myopic focus on tariffs was wrong this spring and this summer. And so hopefully everybody learned something from this. I'm always learning. I don't think I have everything figured out. I'm obviously good at my job, but I'm always learning every day. We're wrong. There are things we get wrong. There are things we get right. And at the end of the day, I think we just all have to keep rolling our sleeves up day after day after day, swinging that axe and chopping that wood. And we'll be right back here tomorrow, swinging the same data-driven axe and chopping the same macro wood for you guys tomorrow. So everyone have a wonderful day. And thanks to the clients for these wonderful questions. I love questions that force me to unpack things that I don't necessarily get to unpack daily here in these macro minutes. Obviously, I'm talking about this stuff every day in our meetings with our Porta Pro clients. And so this was super, super thoughtful. So appreciate you guys. We'll catch you back here tomorrow. Have a great day.